You walk into your kitchen and you see it. Cracked tiles, a leaky faucet, cabinets that barely close. You think, I can fix this. Then you see the price, and suddenly the dream turns into a stress headache. Here's the scary part. The wrong renovation loan can make a simple remodel cost thousands more than you expected, but the right one can upgrade your home without wrecking your budget. And by the end of this video, you will know the sneaky detail most people miss that makes their loan more expensive even when the interest rate looks good. I will tell you exactly what it is later because first, you need the big picture. Number 1, what a home renovation loan really is. A home renovation loan is money you borrow to repair, upgrade, or improve a home. You pay it back over time, usually monthly, with interest. Some renovation loans are based on your credit and income, like a normal personal loan. Others are tied to your home, meaning your home helps secure the loan. Example, you want to replace an old roof. The contractor quotes $12,000. You do not have $12,000 sitting in savings. A renovation loan can spread that cost over a few years so you can fix the roof now and pay monthly. Another example, you buy a house with a broken bathroom and ugly floors. You want to make it livable fast. A renovation loan can fund those upgrades so you can move in and enjoy the home. Number 2, the two big families of renovation loans. Most loans fit into two buckets. Bucket 1 is unsecured loans. These do not use your home as collateral.
Why this matters. Secured loans often have lower interest rates than unsecured loans, but they can also come with closing costs, extra paperwork, and more risk if you cannot pay. Example, 2 people both need $20,000 for a remodel. Person A uses a personal loan and pays a higher rate but has no closing costs and funds quickly. Person B uses a home equity loan and gets a lower rate but pays fees and waits longer for approval. Number 3, the first question to ask before you borrow. Before you even pick a loan, ask this: is the renovation a need or a want? If it is a need, like a leaking roof, electrical hazards, mold, or plumbing issues, speed and reliability matter. You want funding that arrives when you need it. If it is a want, like fancy countertops or a luxury shower, you want to be extra careful. Wants can become budget traps. Example, a broken furnace in winter is a need. A heated bathroom floor is a want. Both can be nice, but only one can turn into a real emergency. Number 4, personal loans for home improvements. A personal loan is usually a fixed amount with a fixed interest rate and a fixed monthly payment. Why beginners like it? It is simple. You get a lump sum, you pay the same payment every month, no home appraisal, often no closing costs. What to watch? The rate can be higher than home-based loans, and your credit score matters a lot. Example, you borrow $10,000 for a bathroom refresh. You get a fixed payment for 4 years. You know exactly what you owe each month, which helps you budget. Another example, you want to install new windows and you want the work done next month. A personal loan can be faster than a home equity option, so the timing works. Number 5. Home equity loans in plain English. A home equity loan is like a second mortgage. You borrow a lump sum based on your equity and you pay it back with fixed payments. Equity is the difference between what your home is worth and what you owe on your mortgage. For example, your home is worth $300,000. You owe $220,000. Your equity is about $80,000. A lender might let you borrow a portion of that for renovations. Why people use it? The rate is often lower than a personal loan. The payment is usually fixed, which feels stable. What to watch? You may pay closing costs. The process can take longer, and you are using your home as collateral. Number 6. HELOCs, the credit card that uses your house. A HELOC is a home equity line of credit. Think of it like a credit line. You can borrow, repay, and borrow again during the draw period. Why it fits renovations? Renovations often happen in stages. Demo first, then materials, then labor, then surprise problems. A HELOC lets you pull money as you need it. What to watch? Rates are often variable. Your payment can change when rates change. For example, you plan a kitchen remodel. You start by borrowing $5,000 for cabinets. Next month, you borrow another $7,000 for appliances. You only pay interest on what you actually borrowed, not the full line. But if rates rise, your monthly cost can jump. That is the risk. Number 7. Cash out refinance, the big reset. A cash-out refinance replaces your current mortgage with a new one, usually larger, and you take the difference in cash for renovations. This can make sense when mortgage rates are lower than what you currently have and you need a large amount of money. This can be a mistake when the new rate is higher than your current rate, or you extend your loan term and pay much more interest over time. Example, you have a 30-year mortgage at a low rate. Rates are higher now. If you refinance today, you might trade a great mortgage for a more expensive one. Even if you get renovation cash, the total cost could hurt. This is why cash-out refinance is not automatically good. It depends on the numbers. Number 8. Renovation loans that bundle purchase and repairs. Some loans are designed for buying a home and renovating it at the same time. These are more complex, but they can be powerful for fixer-upper buyers. How it works in simple terms. The loan is based on the home value after the renovation is done, not just the current broken condition. The lender usually requires plans, contractor bids, and inspections. Example, you buy a rundown house for $200,000. You plan $40,000 in repairs. Instead of getting separate loans, a renovation loan can combine it into one package, so you finance the purchase and the fixes together. The catch: more rules, more paperwork, more timelines. But for the right situation, it can be a game changer. Number 9. Contractor, DIY, and why lenders care. Here is something beginners do not expect. Some loan types care who does the work. If you hire licensed contractors, it's easier to document the project. Lenders like clear bids and receipts. If you plan heavy DIY, some lenders may limit what they will fund or require extra proof. Example, painting and small fixes are easy DIY, but moving plumbing lines, adding electrical circuits, or structural changes often need permits and professionals. A lender may want those details before releasing funds. Even if you can do the work yourself, the lender wants to know the project will actually get finished. Number 10. The budget rule that saves people. Renovation budgets rarely go exactly as planned. Hidden damage happens. Materials get delayed. Prices change. A smart rule is to build a buffer. Many experienced homeowners plan extra room for surprises. Example, you budget $15,000 for a bathroom. Then you open the wall and find water damage. Now you need new subfloor and mold treatment. If you did not plan for that, you might panic and use a high-interest credit card. The buffer is your stress shield. It protects your cash flow and your sanity. Number 11. The real cost is not the monthly payment. This is where people get tricked. A lender can show you a monthly payment that looks affordable, but the total cost depends on the interest rate and the length of the loan. Longer term usually means a smaller monthly payment but more total interest. Example, 2 loans for $20,000. One is 5 years, one is 10 years. The 10-year payment is smaller, but you might pay way more interest overall. So do not ask only, can I afford the payment? Also ask, is this worth the total cost? Number 12. Credit score, debt to income, and the approval basics. Most lenders look at 3 big things. Credit score, this shows your history of paying bills. Debt to income, this compares your monthly debt payments to your monthly income. Stability, this includes job history, income consistency, and sometimes savings. Example, if you already have car payments, credit card payments, and student loans, adding a renovation loan may push your debt to income too high.
Even with a decent score, you could get denied or offered a worse rate. A beginner-friendly move is to reduce small debts before applying, like paying down a credit card balance. Number 13, the sneaky detail people miss: fees and loan traps. Remember that promise from the intro? Here it is. Many people compare interest rates and forget fees. Fees can make a loan with a lower rate more expensive than a loan with a slightly higher rate. Common fees include origination fees, appraisal fees, closing costs, and sometimes annual fees on certain credit lines. Example: Loan A has a lower rate but charges a large origination fee. Loan B has a slightly higher rate but no fee. Depending on the loan size and how fast you repay, Loan B could cost less overall. Another trap is promotional offers. Some deals look amazing at first, then adjust later. The simple habit is this: always ask for the total cost over the life of the loan, not just the rate, not just the payment. Number 14, step by step, how to choose the right renovation loan. Step 1, define the project. Write down what you will do and why. Step 2, get at least 2 or 3 contractor estimates. Even if you plan DIY, price out materials. Step 3, decide your timeline. Do you need money fast or can you wait? Step 4, decide if you want a fixed payment or you can handle a variable rate. Step 5, compare loan types: personal loan, home equity loan, HELOC, cash out refinance, or a renovation-specific loan. Step 6, compare total cost. Include fees, not just interest. Step 7, protect your budget. Add a buffer and do not borrow your absolute maximum. Example: if your project is a safety repair, you might accept a higher rate personal loan for speed. If your project is a planned remodel and you have strong home equity, you might choose a home equity loan for a lower rate and fixed payment. Number 15, a simple renovation loan example, start to finish. Let us make this real. Imagine you want to remodel a small kitchen. You price it out. Cabinets, $6,000. Appliances, $3,000. Labor, $5,000. Flooring, $2,000. Total, $16,000. Then you add a buffer, maybe $2,000 for surprises. Now you plan for $18,000. You compare options. A personal loan offers fast funding and fixed payments, but a higher rate. A HELOC offers flexibility, but a variable rate. A home equity loan offers a fixed payment and a lower rate, but more fees and time. If you want predictability and you can wait, you might pick the home equity loan. If you want speed and simplicity, you might pick the personal loan. If you want stage-by-stage borrowing, you might pick the HELOC. The right answer depends on your situation, not just what sounds popular. Number 16, how to avoid renovation regret. Renovations can make you feel richer because your house looks better, but your bank account can feel poorer if you overdo it. A good rule is to renovate for function first, then for style. Function upgrades include roof, HVAC, plumbing, wiring, insulation, and safety fixes. Style upgrades include fancy finishes that look great but do not always add the same value. Example: replacing a failing roof protects your home and can prevent huge damage. A luxury tile pattern might look amazing but does not stop leaks.
Also remember resale reality. The most expensive renovation in your neighborhood may not pay you back later. Number 17, the fast checklist before you sign anything. Before you accept a loan, slow down and do this quick check. Is the rate fixed or variable? What is the full fee list? What is the total cost if you keep the loan the full term? Is there a prepayment penalty? How fast do you get the money? If it is a home-based loan, what are the closing costs and timeline? Example: if there is no prepayment penalty, you can pay extra when you can and cut the total interest. That one detail can save serious money. Number 18. Will this renovation actually raise home value? Some upgrades can boost value a lot. Others mostly boost comfort. A simple rule: fix problems first, then upgrade what buyers expect in your area. Example: A new roof, modern electrical, and working HVAC often protect value because they prevent scary surprises. But a super expensive luxury kitchen and a modest neighborhood might not increase the sale price enough to match what you spent. Another example, turning one of the only bathrooms into a fancy spa can look amazing, but if it makes the bathroom less practical, it can hurt value for families. Number 19. Permits, inspections, and the hidden budget killer. Permits can feel annoying, but skipping them can get expensive fast. Some projects often need permits, like electrical work, plumbing changes, structural changes, and adding rooms. Example, you finish a basement without permits. Later, you try to sell the home and the buyer asks for proof the work was approved. Now you may have to redo parts of the project or pay for extra inspections.
Another example, a contractor says, "No permit needed," but the city disagrees. You could face fines and delays, and your loan money may sit while you cannot move forward. Number 20. How money is released. Lump sum versus draws. Not every renovation loan hands you all the money at once. Some give a lump sum, like many personal loans and home equity loans. Some release money in stages, especially renovation-specific loans, where the lender checks progress before releasing more funds. Example, you are rebuilding a bathroom. The lender releases money for demolition and rough plumbing first. Then, after inspection, they release money for tile and fixtures. Why it matters? If your contractor wants a big upfront payment, but your loan releases money slowly, you need a plan so the project does not stall. Number 21. Contractor vetting, the boring step that saves you. A renovation loan can be ruined by a bad contractor. Look for clear written estimates, realistic timelines, and proof of licensing and insurance when required. Example, 2 contractors bid $18,000 and $11,000 for the same kitchen. The $11,000 bid has vague language like materials included with no details. That can turn into constant add-on charges. Another example, a contractor asks for a huge deposit before any work starts. A safer pattern is a payment schedule tied to milestones, like after demolition, after cabinets installed, after final walkthrough. Number 22. Protect yourself with a simple paper trail. Paperwork is not fun, but it keeps your project from turning into chaos. Keep a folder with contracts, receipts, change orders, and photos. Example, the contractor says the price changed because you asked for extras. If you have a written change order that shows what you approved, you can avoid arguments and surprise bills. Another example, if you ever need to file an insurance claim for damage during renovation, photos and receipts can speed things up. Number 23. Insurance during renovation. Do not skip this call. Big renovations can change your risk, and your insurance company may need to know. If you are doing major work, ask if your current policy covers theft of materials, damage during construction, or contractor liability. Example, you buy $6,000 of appliances and store them in the garage, then something gets stolen. Some policies may cover it, some may not, and you do not want to find out after it happens. Another example, a worker gets hurt and your contractor does not have proper coverage. That can become a nightmare. Asking for proof of insurance is not rude, it is smart. Number 24. The tax angle most beginners misunderstand. People hear home loan and assume the interest is always tax deductible. It is not always that simple. In general, interest on a personal loan is usually not deductible for home improvements. Interest on some home-secured loans may be deductible if the money is used to improve the home and you meet IRS rules. The rules can change and your situation matters. Example, 2 homeowners both borrow $25,000. One uses a personal loan, one uses a home equity loan. Their tax outcome may be different even if the project is the same. If taxes matter for your decision, talk to a qualified tax professional so you don't build your plan on a guess. Number 25. Rate shopping without wrecking your credit.
Shopping matters because small differences can change total cost. Many lenders offer pre-qualification that may not require a hard credit pull. Then you choose the best offer and complete a full application. Example, you pre-qualify with 3 lenders. One offers a lower rate but higher fees. Another offers a slightly higher rate with no fee. Now you can compare the real total cost instead of guessing. Also, watch timing. Multiple loan applications in a short window can affect your score depending on the type of credit. Ask lenders how their process works before they pull your credit. Number 26. The renovation timeline trap, when delays cost you money. Delays are not just annoying, they can get expensive. If your loan has a variable rate, rate changes can increase your cost over time. If your contractor delays, you might pay interest longer than expected. Example, you open a HELOC and start borrowing in March. The project drags into late summer. Rates rise and your payment jumps while your kitchen is still half done. A simple fix is to plan realistic timelines and order long lead items early, like cabinets or specialty windows. Number 27. Small project, small loan. The right tool matters. Not every upgrade needs a big loan. For smaller projects, alternatives can sometimes make sense, like a smaller personal loan, saving up for a few months, or using a low-interest option if you can pay it off quickly. Example, you need $1,200 for a water heater replacement. Taking a multi-year loan for that amount could mean paying a lot in interest relative to the cost. If you can save for 2 months or use a short payoff plan, you might spend less overall. But be careful. If you cannot pay it off fast, a short-term deal can turn into a long-term problem. Match the tool to the job. You now know the real choices. You know why some loans feel cheap but cost more. You know how to pick based on your project, your timeline, and your comfort level. And here's the best part. When you choose the right loan, home upgrades stop feeling like a financial gamble and start feeling like a plan. So I want to hear from you. What renovation are you thinking about right now, and what is your biggest worry about paying for it?